So you may have heard me tell you in the past that annuities suck. Well, there is some truth to that, if you're doing it for the purpose of growing your money. The average return on most annuities, and I've been doing this for 23 plus years at this point, the average return on most annuities, and I don't care what the annuity is, I don't care what they tell you, is about a 4 to 6% average. The real reason why you use an annuity is for a guaranteed stream of income that you can't outlive for the rest of your life, and most people should probably own one. But what if I told you that all that's out the window now? There's a new product out there today that's averaging 9 to 15% out over a 10-year period of time. Now, here's the reality. The reality is that the past is no guarantee of the future. However, if you believe that the market's going to go up and the market's going to go down, then there's a pretty good chance that it's going to look much like this. Now, if you understand anything about annuities, there's something called a participation rate, a cap, and a spread. Now, a participation rate is how much you make. A cap is the most you can make, and a spread you don't make. You want to know more about that and how caps, spreads, participation rates work, and how annuities work? Stay to the end. I'll show you how you can go out and get a course on just learning all about annuities and how annuities work. But let's talk real quickly about this product. So the second line here, you can see the 1-year S&P 500 point to point, which means from one point to another, as in May 1st to May 1st of the following year. It has a 7.8% cap, and that's the most you can make. On the 1-year S&P 500, it has 11.85% cap with a 1.5% cost. Personally, I'm not going to pay a 1.5% cost to try to get a little bit higher rate of return. The S&P IQ index is at 12.85%. Now, both 7.8 and 12.85 are very, very high cap rates for these types of products. An indexed annuity participates in the gains of the market up to these caps and doesn't participate in the losses of the market. And with no cost unless you choose an index that has a fee. Now, you can go down and you can see all these other ones, but what I want you to draw your attention to is to the second line down here where it says participation rate guaranteed for a surrender charge period. You can see that on the left-hand side, we've put 50% in that index, and then you go down towards the bottom, we put 50% in the 2-year Morgan Stanley Enhanced Allocation Index. But here's where it's really cool. The 1-year S&G is 158% participation rate. The 2-year is 227% participation rate. Now, if you don't understand what that means that if the market is up 10%, it's going to credit 15.8. If the market is up 10%, it's going to credit 22.7. So these are huge numbers, but what makes these numbers so huge and makes this product so cool is that they cannot adjust those participation rates, everything below that participation rate line, they cannot adjust them throughout that period of time of the contract. They can adjust the cap rates above the line, but they cannot adjust the participation rates below the line. They're set. And folks, the reason why annuities make smaller rates of return over the long haul is because over that long haul, they will adjust caps, spreads, and participation rates, and they do. It's just the way it works. And of course, they have to based on what interest rates are. So that being said, take a look at this. Over the last 10 years, this product would have averaged 9.04%. Over the lowest 10 years of a 20-year period of time, it would have averaged 9.04. And over the highest 10-year period of time, it would have averaged 15.83%. Now, take your eyes to the lowest 10-year period of time and notice the third line down. It only made 0.45 in that year. And in the year 9 and 10, it made 0. So it shows that during those period of times that the market was down both times. Well, that being said, there's 3 bad years inside of there, yet it still averaged 9.04. because the greatest thing about index products is they get the gains of the market, but they don't participate in the losses. And that's what makes that average so good. Now, I don't know where you're putting your money, and I don't know how well you're doing in the market, but if you're doing better than a 9% average on your money over time, especially in a tax-deferred environment, that's pretty incredible. If you've got money laying around in CDs or accounts that you're worried about the risk that's going on with them, or I'll tell you a really good product for this, and that would be a Roth IRA. Putting a Roth IRA in here because you're not going to be touching it over the long haul, that's a great place. You still maintain 10% liquidity of your account value over that 10-year period of time. If you want to know more about this, certainly reach out. Now, I told you if you were here at the end that you would get an opportunity to go and learn more about annuities. I've put out a new course just on annuities. So if you want to learn more about annuities, just click on the link down below, and for a nominal cost, you can go learn pretty much everything you want to know about annuities. Always feel free to reach out. Please put some comments in the bottom about what you think about what I've just shown you. Subscribe to our YouTube channel, and I look forward to meeting each and every one of you. Remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Keep smiling and make it a great day.